Good evening to one and all. Before we go with the program, we will start with the prayer song.
வாழ்வினில் செம்மையே செய்பவள் நீயே, மாண்புகள் நீயே, என் தமிழ் தாயே, வீழ்வாறு வீழாது காப்பவள் நீயே, வீரனின் வீரமும் வெற்றியும் நீயே, தாழ்ந்திடு நிலையிலே உனை விடுப்பேனோ, தலை குனிவேனோ, சூழ்ந்தின்பம் நல்கிடும் பைந்தமிழன்னாய் தோன்றுடல் நீ உயிர் நான் மறப்பேனோ, செந்தமிழே உயிரே நருந்தேனே, செயலினை மூச்சினை உனக்களித்தேனே, நைந்தாயனில் நைந்து போகுமென் வாழ்வு, நன்னிலை உனக்கெனில் எனக்கும் தானே, முந்திய நாடினில் அறிவுமில்லாது மொய்த்தனன் மனிதராம் புதுப்புனல் மீது செந்தாமரை காடு புத்தது போல செழித்த என் தமிழே, ஒளியே வாழி, செழித்த என் தமிழே, ஒளியே வாழி, செழித்த என் தமிழே, ஒளியே வாழி.
Happy evening. Respected Speaker of the Day, CA Banusekar, Advocate K. Vaitheeswaran, respected CA AB Arun, Regional Council Member for the term 2022-25, CA Sharada Ashok, Past Chairman of Salem Branch of SIRC of ICAI, CA Manju Bhashini, Secretary of Pondicherry Branch of SIRC of ICAI, CA Pushpalata, Secretary of Salem Branch of SIRC of ICAI, Dear Office Bearers of Pondicherry and Salem Branch of ICAI, beloved members of Pondicherry Branch, members of Salem Branch, and other members of ICAI, and other distinguished participants. Happy evening to all. We are happy to receive you all for this seminar on budget proposals in direct and indirect taxes in the Finance Bill 2022. We are delighted to extend our heartiest welcome on behalf of Pondicherry and Salem branches of SIRC of ICAI to CA Banusekar and Advocate Vaitheeswaran in absentia, who will join us after completing his program in Kerala, the speakers of the day. We are privileged to have stalwarts in the respective fields as speakers for our today's program. We heartfully extend our acknowledgement to both the speakers, Sri Banusekar and Advocate Vaitheeswaran, for accepting our request for this program on budget proposals being held within 3 days from the day the budget being laid down in the Parliament, in spite of their hectic schedule of many such programs. The speaker for the session, Direct Access Proposals in Finance Bill 2022, C.A. Banusekar sir, is a good orator and good interpreter of law and bring out the nuances of law with great clarity and authority. We are delighted to have him as the speaker for the Direct Taxes Proposals in the Union Budget 2022 and looking forward for a brainstorming session. We welcome you, sir. We welcome all the members of the Pondicherry, Salem branch members and members of other branches and also other participants for this seminar. We extend our special thanks to Regional Council member for the term 22-25, CA A.V. Arun for participating in this seminar and contributing by fixing the speakers and extending all the support for this program. Union Budget 2022, though it is widely said that it has no much in store, reading between the lines of the finance bill has many far-reaching implications and issues. New concept of capital gains on sale of virtual digital assets, updated return, amendments in tedious provisions will open up the Pandora box on various issues and with no doubt will open up new opportunities to chartered accountants as well. Our heartiest thanks to all the distinguished members and guests for sparing their time and taking part in this seminar despite having back-to-back seminars being held yesterday on GST and today on budget proposals. In spite of busy schedule on account of tax audit, members have turned out in large numbers, only point to prove that members are keen to update their knowledge on the budget proposals, and we once again are delighted to welcome you all. With these four words, I welcome you all for the program and requesting the Secretary CA Manjubhashni Madam to introduce the speaker of the session, CA Banusekar sir, to the participants.
Thank you, sir. Good evening, ladies and gentlemen. It is indeed a great pleasure to introduce the first speaker of today's program, CAT Banusekar, my guru. CAT Banusekar is in practice as a partner in Messrs. CRBS and Associates LLP, Chennai since 1994. He has contributed articles on direct taxes and international taxation to several tax journals, including Consolidated Commercial Digest, Taxman, Tax Referencer, and the Income Tax Review. He has argued a number of landmark cases before various benches of ITAT across the country, which has resulted in establishing precedents for many contemporary issues. Few of such cases are Ford India Limited relating to claim of deduction for warranty expenses, Saxoff Limited before the special bench on parity between numerator and denominator in computing deduction under 10A, Ford Business Center Private Limited relating to the benefit under Section 10A, SSI Limited relating to taxability of ESOP, Vijaya Productions relating to the accrual of capital gains, Apollo Hospital Enterprise Limited relating to taxability of capital gains earned in India on sale of shares in Sri Lankan company, Eastman Exports Global Clothing Private Limited relating to taxability of export incentive in the form of MLFPS scrips, Filtrex Technologies Limited relating to disallowance under Section 40A1, Playtex Limited relating to application of provisions of Section 163, South India Corporation Limited relating to disallowance of interest paid on borrowed funds on account of interest-free advances to group concerns, AVM Charities relating to exemption of claim of exemption under Section 11, Healcraft Pharma Limited, Healcraft Pharma India Private Limited relating to allowability of sales promotion expenditure in the form of freebies and gifts incurred by pharmaceutical industry in light of the CBDT Circular 5 of 2012. The list actually goes on, but I'm stopping at the last one, Synergy Maritime India Limited, relating to transfer pricing issues. He has also argued number of cases in various benches of the Income Tax Settlement Commission. He has authored 2 books, namely Handbook on Assessment Procedure under Income Tax Act 1961 and Search Assessment under the Income Tax Act. He was formerly a visiting faculty at ICAI, Company Secretary of India, and Loyola Institute of Business Administration on direct taxes. He has delivered lectures and presented papers on direct taxes and international taxation at seminars, meetings, workshops, and conferences arranged by ICAI, SIRC of ICAI, as well as other regions of ICAI, apart from those organized by other professional and public bodies, including several branches of various regions of the ICAI. He had actively participated as a trustee in brain trust sessions organized by branches of ICAI. He has participated in training programs for the commissioners of income tax conducted by the regional training institutes of income tax department and also Central Training Institute. He has been the chairman of the Direct Tax Committee of Hindustan Chamber of Commerce, was formerly a columnist in Hindu Business Line, in Personal Financial Page, featured on Sundays, authoring the column Tax Talk. He was a former member of the SIRC of ICAI for the period 2001-2004. He was the past chairman of the Fiscal Law Committee of SIRC of ICAI. He was a special invitee in the Direct Tax Committee of ICAI and in Continuing Professional Education Committee of ICAI. He is presently a co-opted member of the Direct Tax and International Committee of SIRC of ICAI. With these words of introduction, I welcome CAT Banusekar, my teacher, to this program. Welcome, sir. Over to you.
Thank you, Manjubashni. 2 things that I will say before I start. One, the biodata was entirely scripted by me, so it will only say the fine things about me. And 2, as admitted by Manjubashni, she was my student, and she doesn't have the courage to say anything else about me either. Well, friends, as the chairman of the Pondicherry branch pointed out, there have been a number of changes made by the finance bill on the direct tax proposals. And in order to discuss this, I think the program was organized. In fact, when I was contacted to do this program, I was really wondering whether there will be changes at all. After I heard the finance minister's speech, I was convinced that there are going to be no changes. In fact, I had already told my office, you take out what are all the amendments that came between 2021 and 2022 by the finance bills, where various notifications have been issued. We may have to talk about that because we have 1 hour to talk and we don't have enough material. The finance minister spoke for hardly 3 minutes. But then, friends, I thought I was mistaken when the bill was uploaded. Within a few minutes thereafter, the bill was uploaded. And I realized that I was thoroughly mistaken. There were only 84 amendments made to the direct tax in the Income Tax Act. So that gave me a lot of breather, and in fact sometimes had me wonder whether 1 hour would still be enough. But then I decided I will not impose myself for more than an hour, despite the request to the organizers that I should extend it. I thought we will restrict ourselves for the time being to 1 hour, because we do not know which of these will become part of the act and which of these will not. So before I start presenting the various amendments, first of all, my sincere thanks to the branches, the Pondicherry and the Salem branch and its office bearers, and also the regional council member, Mr. Arun, for giving me this opportunity to share my thoughts on the budget, the direct tax proposals. Because one thing that happens as a result of this, in fact, the chairman of the Pondicherry branch was saying within just 3 days. But then if we don't do anything now, we generally don't do it at all. That is what happens. So what happens with these meetings which come back to back is that we are forced to read immediately and keep ourselves updated. In fact, to be honest with you, I already have 2 opinions in hand. I think there is an echo. Is there a difficulty for the rest, or is one of the participants has put up a chat? there's an echo. Is there an echo? Or am I okay?
Yes, sir.
Am I okay or is
Yes, sir. Yes, sir. Now, if you can unmute yourself and yes, I have muted all. So if you can unmute and continue, it will be clear, sir.
yeah? Is there an echo now?
No, sir. No,
Okay.
sir. Yes, sir.
Fine. Thank you.
Thank you, sir.
So what happens is that we are forced to read these provisions and keep ourselves updated, I was saying. And in fact, two people have already asked opinions on the amendments made. So that keeping ourselves on our toes on this also ensures that we are able to reply to the opinions in writing as quickly as we can, because we are ready and updated. So I'm grateful to the branch for giving me this opportunity, because these are reading opportunities for all of us. And I'm also grateful to all the participants for attendance in fairly large numbers. Now, before I proceed to the major amendments on the aspects relating to business, first of all, a couple of small amendments related to personal taxation. One is the surcharge, which the finance minister in her speech said would be capped at 15% on capital gains. Here, there are just two aspects that I need to point out. One, you will all recall that the surcharge is graded. If the total income exceeds 50 lakh and is up to 1 crore, the surcharge is 10%. Beyond 1 crore and up to 2 crore is 15%. Beyond 2 crore and up to 5 crore is 25%. And beyond 5 crores is 37% of surcharge. Now, what happens here is twofold, two things that need to be remembered. One, if the capital gains after being included in the total income, if the total income is, say, less than 1 crore, then the surcharge will be only at 10%. For example, if my total income is, say, 90 lakhs, which includes 10 lakhs of capital gain, my surcharge on the total tax on total income would be only 10%, because the law is very clear that the surcharge will be capped at 15. It doesn't mean that the surcharge on capital gain will become 15%. Likewise, what is to be reckoned for the purpose of surcharge is the total income. So let us assume I have a total income of, say, 5.5 crore. And let us say out of this, my capital gain is 1 crore, which means without my capital gain, my total income is 4.5 crore. Now, what should be the surcharge? On the sum of rupees 1 crore, which is my capital gain, the tax thereon, my surcharge will be restricted to 15%. On the balance of 4.5 crores, the surcharge on the tax on 4.5 crores will be at 37%. That is because your total income has exceeded 5 crore. This is another aspect that I thought I should point out. COVID related, because any family member has received as a result of that person's death within a period of 12 months from the date of death, any sum, then if it is received from the employer, it is exempt without any limit. But if it is received from a person other than employer, it is exempt up to a limit of 1 crore. This amendment will apply from assessment year 21-22 itself. That is from the financial year 2021 itself. Now, one thing is, what is a COVID death will become an issue, because as I understand, the government does not recognize as a COVID death a death after the person exceeds a specified time span of, say, 14 days from the date of testing positive, or if before death the person has already tested negative. He might have died as a result of COVID complication, but it is still a non-COVID death as per government records. So such persons' families may not be able to get the benefit of this amendment. The next, as far as this is concerned, is an 80DD. In fact, that arises as a result of Supreme Court decision observations, where the Supreme Court, in one of the decisions, in a writ petition, made certain observations saying that in the event of any person who is handicapped receiving any sum as a result of a policy taken as a result of any benefit that is received by him, as when a person has contributed for his benefit, then it is taxable in the hands of the dependent. The Supreme Court observed that it should not be taxable, and therefore they have made an amendment saying it will not be taxable provided the person who has contributed has reached the age of 60 and the person who has contributed has stopped making the contribution. If any one of these conditions are satisfied, then the benefit of the exemption will not be available to the handicapped person. I'll move on to some of the business aspects relating to the business aspects. The first of these is in section 14A. Now, section 14A provides for a non-deductibility of expenditure incurred to earn exempt income. Non-deductibility of expenditure incurred to earn exempt income. This debate has been going on for a very, very long time as to whether it is allowable. There was a decision of Supreme Court in Rajasthan State Warehousing Corporation, where the Supreme Court held that even if the expenditure is incurred to earn an exempt income, if the assessee has other non-exempt income, the expenditure to earn the exempt income can be claimed against the non-exempt income. In order to get over this decision, section 14A was inserted. Now, 14A is being interpreted by the various courts. One of the issues that has been consistently arising is, what if there is no exempt income in the year? Can there be a disallowance under 14A? Can there be a disallowance under 14A where there is no exempt income in the year? They are now proposing to amend section 14A with effect from assessment year 22-23. Please note, with effect from assessment year 22-23, to provide that the 14A disallowance can be made even where there is no exempt income. 14A disallowance can be made even when there is no exempt income. There are various aspects that need to be noticed here. One, that 14A itself has been substantially diluted now, because earlier you will remember that dividend income was exempt from tax. Now dividend income is no longer exempt from tax, so investment in shares will not be affected by the provisions of 14A. Two, the amendment that is made in 14A is clearly prospective in nature. It says it is applicable from assessment year 22-23. But then if you see the manner in which the amendment is proposed, it says for removal of doubts. So a question arises. Is this a prospective amendment or is this a retrospective amendment? Becomes a question that arises, because it says for removal of doubts, but again says applicable from assessment year and specified assessment year 22-23. Now, in my view, this amendment is clearly prospective in nature and not retrospective in nature, even though the language used is for removal of doubts. This has been said or clarified in a number of decisions in the context of 36(1)(5)(a), where amendments were made, where again it said effective from assessment year 21-22, but said for removal of doubts. In fact, one of the classic decisions is the decision of the Chennai tribunal in a case called Adayar Ananda Bhavan, where the Chennai tribunal held that the amendment in 36(1)(5)(a) is prospective in operation. A similar view, in my opinion, can be taken in the context of the proposal in 14A also. In fact, there is also a decision of the Madras High Court. I'm not able to recollect the citation right away, in the context of explanation 5 to section 32(1), where they say, even though it says for removal of doubts, it does not mean it is retrospective in operation. No, but then there is a more important facet that occurs to my mind. Now, the present provisions of 14A clearly provide that the disallowance should not exceed the exempt income. Okay. Earlier, prior to the amendment made in 14A to say that the disallowance should not exceed the exempt income, there were a number of decisions of the courts a number of decisions of the courts where the courts held that the disallowance cannot exceed the exempt income. You had the Madras High Court in Chettinad Logistics, you had various decisions, including the Delhi High Court in joint investments, etc., where they held that the disallowance cannot exceed the exempt income. Now, I would not understand how this amendment can be effective when I have no dividend income. How 14A can be operated even with the proposed amendment? The proposed amendment says 14A can be applied even if there is no exempt income at all. But my disallowance cannot exceed the exempt income. So the only situation where it will affect is, supposing I have two exempt incomes, one of it yielding dividend income, the other not yielding dividend income, then I will have to take the non-dividend yielding, non-exempt income also, or the investment which does not yield me the exempt income also, for the purpose of making the computation under 14A read with Rule 80. That is the only circumstance that I can think of where 14A will be, the amendment can be made effective. Next is under 37, where they are talking about certain expenditures not to be allowed. Again, there are two major changes that are proposed in section 37.1. One major change is to provide that if an expenditure is incurred for a purpose which is an offense or which is otherwise prohibited by law, and where the offense is not an offense contemplated by an Indian legislation, but by a legislation outside of India, still the disallowance under 37.1 can operate. Friends, the law as it stands presently provides for a disallowance where the expenditure is incurred for a purpose which is an offense or which is otherwise prohibited by law. Courts have interpreted this to say that this will apply only if it is a case where it is a law in India. Now they are trying to expand the scope to say that this will apply even if it is in prohibition of a law outside of India. Now I have a serious question here. Can an assessing officer really understand what is prohibited by a law which is there outside India? So will somebody, an assessing officer who is sitting in India, interpret the law which is made outside of India? Does he have such powers at all? See, first of all, my question is, can he interpret any other law other than the income tax law? But then now we are going a step further that he can interpret not just any other law outside the income tax, but a law outside of India also. That seems to be extremely far-fetched, but that's how we are proposing the amendment. The next amendment is to provide that if there is a benefit or perquisite provided in violation of any law or rule or regulation or guideline governing the conduct of a person, if there is any benefit or perquisite provided to a person in violation of any law, rule, regulation, or guideline governing the conduct of such person, then the disallowance will operate. In fact, when my biodata was being read, when I was being introduced, one of the cases that they read out was Healcraft Pharma Private Limited. There, the issue was with regard to a pharmaceutical company, where the pharmaceutical company had provided certain benefits by way of perquisite to the doctors, by way of freebies, etc., to the doctors. Right? Now, a question arose whether this is allowable. Now, why this question arose was because the Medical Council of India, the MCI, amended the regulations of the MCI to provide that doctors should not accept any benefit or perquisite from any person, including pharmaceutical companies. Right? Now, we had taken a plea before the tribunal and also before various courts that what is prohibited by law. But before that, the board issued a circular number 5, where they said that the Medical Council of India guidelines say that a doctor should not take any benefit. Therefore, if a benefit is provided by a pharma company to a doctor, then it should be disallowed under 37(1) because of the explanation. We had argued saying that the prohibition of the Medical Council of India is on the doctor. The prohibition of the Medical Council of India is on the doctor. It is not on the pharmaceutical company. Because the MCI guidelines only govern a doctor, they don't govern the pharma companies. So while a doctor should not accept, the pharma companies are not prohibited from giving. Therefore, it is not an offense under any law for a pharma company to give. And consequently, therefore, we said that it should not be disallowed. The tribunals and most tribunals accepted this view and said it cannot be disallowed in the hands of the pharma company. There were other arguments which I will not get into, but suffice it to say for the time being that the courts accepted this view because there was no prohibition on giving. Right? So now what we are seeking to do is to amend or proposing to amend section 37(1) to say if it is in violation of any law or rule or regulation or guideline governing the conduct of such person. Conduct of which person, it says expenditure incurred to provide a benefit or perquisite in whatever form to a person, whether or not carrying on a business or exercising a profession. So when they say that person, the person who is the recipient is probably what they are indicating. So if you say the person is the recipient, now come back to our Medical Council of India example. If we come back to our MCI example, then the doctor is not permitted to take. Therefore, the rules governing his conduct do not permit him to take. Therefore, it will not be allowed in my hands. The deduction is what they are proposing. But then the amendment says violation of any law, rule, regulation, or guideline governing the conduct. So they are talking about guideline also. So let us assume A company wants to get a purchase order from B company and gives a benefit or perquisite to the purchase manager of B company. Now it may be in violation of the guideline of the purchase manager of B company to accept a benefit or perquisite in the course of his employment. So even that may be affected by this amendment that is proposed in 37(1). So one may have to examine, as a nursing officer, I may have to examine what is the conduct governing that person before I decide the allowability or otherwise in the hands of the person who is the giver. Again, one will notice that this amendment is proposed from 1/4/2022, that is from assessment year 22-23. So this will be prospective in operation. This will be prospective in operation and not retrospective in operation. So very clearly there can be little doubt because this does not even say for removal of doubts. Therefore, the doubt that I earlier raised in the context of 14A may not even arise here. The next amendment which I will discuss is an amendment in section 40. Now there were a number of decisions, including the decision of the Bombay High Court and the Rajasthan High Court, where the courts had held that education cess will not be disallowed under 40 as being part of tax. Tax, you will recall, is not an allowable deduction by virtue of the provisions of section 40. But the courts had held that education cess is not in the nature of a tax, and therefore the disallowance will not operate in respect of education cess. Now they are seeking to amend this provision to provide that education cess can be disallowed under section 40. Education cess can be disallowed under section 40, and it will partake the character of tax only. And this amendment, mind you, is made with retrospective effect from assessment year 2005-6, not from now, effective from 5-6, that is even from the time when education cess was introduced. Incidentally, I was reading in the paper yesterday that some top officials have clarified saying that the amendment in section 40 that is proposed is not retrospective. You will recall the amendment made in section 9 after the decision of Supreme Court in Vodafone. The amendment in section 9 after the decision of Supreme Court in Vodafone, where they clearly made it retrospective in operation. Now, what the tax authority, the top authority says, this is not retrospective, this is only clarificative. I don't understand. That way, if you look at it, even the amendment in 9 is only clarificatory. That is what they said, but it is retrospective in operation. But they say 9 was made retrospective. This is not retrospective. That is probably because this government, when they came to power, said we will not make retrospective amendments. So they are trying to say this is not retrospective, this is only prospective. This is only clarificatory. But the effect is the same, it is retrospective only. I do not know about the language that is being used. The next amendment that I will deal with is an amendment in section 43B. In fact, in this context, there were two conflicting decisions of the Supreme Court itself. One, the decision of the Supreme Court in Aqua Technologies, and two, the decision of Supreme Court in Gujarat Sipromat. Now, in both of these, the issue was what will happen if an interest is converted on loan is converted into a fresh loan or is converted into a debenture, whether it is allowable as a deduction, and will 43B take it as having been paid. In Aqua, the Supreme Court held it is deemed to be paid, therefore it is allowable. In Gujarat Sipromat, Supreme Court said no, it cannot be allowed. Now they are seeking to amend this to provide that it will not be allowed. Of course, one may notice that as and when that loan, that interest on loan is converted into a loan or debenture, as and when that loan is repaid or when that debenture is redeemed, it is definitely deemed to be paid, and 43B will allow you to claim the deduction that year, but not in the year of conversion, but in the year of repayment or redemption, as the case may be. Incidentally, you will also notice that this amendment is made with effect from 1/4/23. That is assessment year 23-24. So does that mean that up to assessment year 22-23, they are accepting the decision of Supreme Court in Aqua Technologies, where the decision was rendered in favor of assessment? I would think so. The answer has to be yes. The answer has to be yes, for the same reasons that I explained earlier in the context of section 14A. Now, probably one of the most far-reaching, or I would call unfair, or even go to the extent of saying dangerous amendments, is made in section 68 of the Income Tax Act. And what is this? To put it in very simple language, section 68 seeks to provide that if there is a credit found in your books of account, you are supposed to prove to the satisfaction of the assessing officer the credit, so that it will not be deemed as your income. It will not be deemed as your income. But then one may notice that the courts have consistently held that there are three criteria for this. One is that the identity of the creditor must be demonstrated. Two, the genuineness of the transaction must be demonstrated by the borrower. And three, that the borrower, that is the assessee, must be able to prove the creditworthiness of the lender. Three criteria: identity, genuineness, and creditworthiness. Now the question arose, I have taken a loan from the chairman of Pondicherry branch. Should I prove his creditworthiness, Or if he has taken a loan from somebody else, say, should I prove the creditworthiness of that third person also? Courts have been very consistent in saying that what needs to be demonstrated is the source and not the source of source. So I need to prove the creditworthiness of the creditor, not the creditworthiness of the creditor or the source of source. But they are now seeking to amend section 68 to provide that I need to demonstrate the creditworthiness of not merely my creditor, but also of the also have to demonstrate the source of source. I think this is extremely far-reaching and extremely dangerous. Why I say so is because if I am a lender, I'm okay. I can ask for any number of proofs, etc. from you. But I'm a borrower. I'm actually coming to you with a begging bowl saying, please lend me money. Now, first thing is, when you lend me money, I must take from you a confirmation that you have the source, whatever, what is your source, etc. Because I need to prove it to the officer. Then I need to ask you, what is your source? Then I must demonstrate that the person who gave you that money has also the source for it. I do not know how practical or feasible it is in a business environment to demonstrate this much. I'm afraid this may be a very, very difficult proposition, and this may not be possible at all. Right? If that be so, then we are stuck, not being able to prove the source of source and it being deemed income without being able to demonstrate the source of source. I think this is an extremely dangerous amendment, and I am afraid that this should not happen in reality. If it does, I think many people who are carrying on business and who are affected by the provisions of 68 may have a lot of difficulty in proving that the addition should not be made under section 68. The next change is in sections by insertion of, by the proposal to insert a new section 79A, where they say if undisclosed income is found as a result of search or survey, then there will not be allowed any set-off of brought forward losses or unabsorbed depreciation. There will not be allowed the set-off of any brought forward losses or unabsorbed depreciation, which means that undisclosed income found as a result of search or survey should be assessed in standalone basis. No set-off of losses permitted. Again, to my mind, they seem to be wanting to make life more and more difficult. If an undisclosed income is found and if I have a brought forward loss, it should be permitted to be set off. First of all, to imagine that somebody who has already losses to be carried forward will keep, unaccounted income itself is a little unfanciful to me, because if I have brought forward losses, why will I not show the income? That itself is a little fanciful to me. But then to say it will not be set off, etc., is putting burden on burden on burden. Already you will realize that the tax rate on income which is found as a result of search, if it falls under the provisions of 68 to 69C, is 75%. The penalty thereon is another burden which can go up to 200%. And thereafter, you have this. I really won't understand how many punishments they are going to give for one offense, if at all that is committed. Right? But then, in my understanding, somebody who has a brought forward loss is very unlikely to have undisclosed income. He should not have. So, which means the undisclosed income itself has been something which is not exactly found but has been accepted, which we are aware of. In many cases, though not much is found, ASIS accept, saying, okay, it's all right, we'll purchase peace in the department. Now, what is undisclosed income is also defined in section 79A to say what is not already recorded in the books of account or documents which is maintained in the normal course, or what is found to be false had it not been for the search or survey. Right? Had it not been for the search or survey. There are also a couple of amendments relating to, new domestic companies and startups, where they are only extending the time frame for the benefit of the deduction. For new domestic companies, they are providing that the benefit of the 15%, that is a reduced rate of tax, will be available if the commencement of the business or profession is before 31/3/24. Now it is extended from 31/3/23 to 31/3/24. So if the business or profession is commenced before 31/3/24, the benefit is available. Likewise, they are seeking to amend the provisions of 80IC to provide that startups will be eligible for the benefit of 80IC if the incorporation is before 31/3/23 as against 1/4/22. It is 31/3/23. Right? These are two changes that are proposed. Couple of amendments which will affect business associates, but is only basically a procedure, but still I will mention, where you had decisions which talked about what happens in case of business reorganization. Can the predecessor be subject to assessment? The successor, see, there is a successor in business. You are, let's say there is an amalgamation. You want to assess the amalgamating company after the amalgamation. Can you assess the amalgamating company after the amalgamation is over in the name of the amalgamating company itself? The courts, including the decision of Supreme Court Maruti Suzuki, said that is not possible. That is not possible. So now they are seeking to amend it by way of clarification to provide that it is valid. Such an assessment is still valid though it is made on the successor, even though on the predecessor, even though it has been succeeded by another company, by another assessor. This amendment again is made with effect from 1/4/22. So in my understanding, they are accepting the position that all assessments framed prior to this date made in the name of the predecessor are invalid. Of course, they are also seeking to insert a new section 170A to provide for a mechanism by which, in case there is a restructuring of a business, say by way of demerger, say, the restructured or the reorganized business will be able to file a fresh return. That is again a procedural amendment that they are seeking to make. Now, the next of the changes that I will deal with is in the context of capital gains, where they are seeking to insert a new section 247A. Section 247A to deal with virtual digital assets. To deal with virtual digital assets. Right? Taxation of virtual digital assets. Now, I can spend some time on this, but probably we need to have a lot more clarity that will come. But we may have to discuss this at a later point in time, because lack of clarity is also there in the present things, because they say any other digital asset which may be notified by the government, they are talking about the RBI issuing some currency, etc. All this has to be waited. We have to wait and see. This was also spoken about by the finance minister. Now, what they are saying is, if there is a virtual digital asset, then A, if I receive a gift of a virtual digital asset, it becomes income in my hands. B, that the transfer of a virtual digital asset will result in a capital gains, which will be taxed under a new section 115 BBH at 30% flat. No basic exemption, no deductions, no exemptions, nothing. Flat rate of 30%. But that apart, they are also making it clear that there will be no inter-source adjustment permitted if a loss arises from the transfer of a virtual digital asset. So likewise, the loss arising from the transfer of a virtual digital asset cannot be carried forward also. So losses will be ignored, profits will be taxed at 30% flat without the benefit of any deduction in computing such tax. Now, two important aspects here. A is that One, you will see that this amendment is made with effect from assessment year 23-24. It is proposed from assessment year 23-24. That means, in my understanding, they are accepting that up to assessment year 22-23, it is not taxable. The gain arising from transfer of cryptocurrencies is not taxable. Is that what they are accepting? In my understanding, that should be the position. The second and the most important is, in my understanding, dealing in cryptocurrencies or these virtual digital assets, mostly, in my understanding, are illegal. Because again, in my understanding, they may be violative of the FEMA. Now, does this amendment mean that they are accepting the transaction to be legal? My understanding is no. They are not accepting the transaction to be legal. You pay tax on the illegal transaction. You pay tax on the illegal transaction. Whatever consequences you will be visited with for carrying out an illegal transaction or independent, that action can be taken under law in accordance with that provisions of the Act. That is how I would think the law should be understood. They are also bringing in a tedious provision for transfer of virtual digital assets, where they say that the person responsible for paying will have to deduct tax at 1%. Now, here I have certain reservations. Now, the person responsible for paying may be a company which is completely located outside India. See, these virtual digital asset transactions happen in remote locations. The server may be located, say, somewhere in Seychelles, where you don't have a tax, you don't have a DTA, you don't have an income tax act, nothing. You can't get exchange of information, nothing is possible there. Now, the company may be located outside of India, say in a place called Seychelles, or in the Cayman Islands, or somewhere like that. Now, you are imposing a tedious obligation on them. Are they bound to follow the tedious provisions of India? Two things that you will notice. One, you have the decision of the Supreme Court in a case called GE India, where the issue was, what if the income is not taxable in India? Is the tedious provision applicable? They said no. So can the person who is responsible for paying now look into whether it is taxable? Am I a resident, non-resident, resident but not ordinary resident? Where did it accrue? Where did it arise, etc.? I don't know whether they're responsible at all. And two is an obligation which is cast on a foreign entity. Should he deduct tax? Now you have a decision of Supreme Court in Vodafone India, where in 341 ITR 1, where one of the observations of Justice Radhakrishnan in a concurring decision, he had said that a foreign entity cannot be put .
Sir? Sir, you are not audible, sir.
In some network issue with sir.
Network. Yeah, yes, madam. Yeah. Let us wait for his message.
Shall we call him over the phone, sir? Shall I call him over the phone?
Yes, sir. Yes, yes, madam. I think he is coming back.
Sir is relogging in a minute. We'll just wait, sir. Some technical issue with his laptop. He said he is relogging in a minute.
I'm sorry for the inconvenience. I'm back after a short break. I do not know what happened, but technology helped me to take this break by my machine suddenly rebooting all by itself.
Okay.
I did nothing because I don't know much about computers to do anything also. But it did it all by itself. I'm extremely sorry. But well, it probably gave you a deserved break also from the monotony of listening to the direct tax proposals continuously. Well, coming back, remember that we were talking about the provisions of virtual digital assets, where I was saying that the decision of Supreme Court in Vodafone India, where the Supreme Court held that an obligation to deduct tax cannot be cast on a foreign entity. And they amended section 195. They have not made any corresponding provision in 194A. Therefore, whether a foreign entity is required to deduct tax at source will be a debatable question. I'll move on to a couple of changes in relation to charitable trust. There are a number of changes. Most of it is to bring parity between 1023C and section 11 trust institutions. But then three major changes that need to be noticed, which I will only touch upon. One is that they are proposing a penalty. They are proposing a penalty with effect from assessment year 23-24, where there is a violation of the provisions of 13(1)(c). 13(1)(c) says that if a benefit of perquisite is derived by a person referred to in 13(3), 13(3) talks of the founder, the author of the trust, etc. And says if a benefit of perquisite is derived by a person who is referred to in 13(3), then the trust will lose exemption. Now that apart, now they are seeking to bring in a penalty. Now what does this penalty provide for? The penalty provides, provisions provide, the penalty provisions provide that there will be a penalty of 100% of the amount of violation of 13(1)(c) if it is a first violation. But if there is a violation in subsequent year or year, second or third violation, then the penalty will be 200%. The penalty will be 200% of the violation. Again, as I told you, they are trying to flog the dead horse. 13(1)(c) violation means I have to pay tax, I have to pay a penalty, I have to go through prosecution. Now I have to pay a further penalty. I won't even have the money. I may not even have the money to pay all of this. So they will effectively be closing down the trust or institution, rather than these are measures which may kill the goose that lays the golden egg. Right? So one more penalty they are contemplating. I think this is a little, uncharitable to a charitable trust, because if you see 13(3), it says if donation has been given by a person in the aggregate exceeding 50,000, then he is a person referred to in 13(3). So let us assume a person A has given donations on various dates to a charitable trust or institution, it's aggregating 50,000 or more. He is a specified person. Now, supposing at a later date, he is given a benefit by the trust because he is suffering. That is a 13(1)(c) violation. And the trust may not even know that they are committing a violation, because they may not even have the aggregate of the donations given over a period of time. I may give 2,000 today, 3,000 tomorrow, 5,000 tomorrow. Nobody knows. Nobody may have a record at all. But if later on the department finds it out, there can be a penalty also, is a danger. Another major amendment is that you will recall that the law presently permits you to accumulate income for up to 5 years. And the law provides that if you don't utilize the accumulated income within the accumulation period, it will become the deemed income of the year following the accumulation period. So if you are accumulating for 5 years and you don't utilize it within 5 years, it will be deemed income of the 6th year. The law is now sought to be amended to provide that it will become accumulated, it will become the deemed income of the year in which the accumulation period ends. That is the 5th year itself, say, in the example that I am taking. That is another major change that they are proposing. Now, this means that in the 6th year, I could have applied it for some other purpose in the consent of the assessing officer and got rid of the taxation. But now I cannot do that. That is gone. Right? The next or the third major change is that they are saying if a trust loses exemption, how you should compute the income of the trust. They are saying that if money is spent out of corpus, that will not be allowed as expenditure. If money is spent out of loan or borrowing, that will not be allowed as expenditure. If money is spent out of or depreciation is claimed on assets which are assets on which application, where the asset has already been claimed as application on depreciation will not be allowed, etc. And they are also saying that the provisions of 40 small a and 40 capital A will apply. I'll move on to the procedures. The first major, most important change which was spoken about by the finance minister is about updated return. And where she said that we are now providing for an updated return. First thing is only one updated return can be filed for a year. And not everybody can file an updated return. If it is a loss return, you cannot update it. If it is a return which has the effect of reducing your tax liability or increasing your refund or making a fresh claim for refund, you cannot update a return. Next is the updated return has to be filed within 24 months, whether your return which is sought to be updated is the original return filed under 139(1) or a belated return or a revised return. And certain other persons are prohibited. For the persons who have been searched or surveyed for those years, they are prohibited from filing updated returns. Likewise, if your income is related to a person searched or surveyed and you have already got notice that your income is related, then you are prohibited. Likewise, if you are a person who has violated certain laws like the Benami Transaction Act, Money Laundering Act, etc., for those years also you are not eligible for filing an updated return. They also say if a prosecution has been launched, then for that year also, you are not entitled to file a updated return. So if the prosecution is for, say, violation of TDS, still for that year you are prohibited. It is not a prosecution for income. Likewise, if your income has already been assessed, you are prohibited from filing an updated return. These are the conditions. So please note that an updated return is different from a revised return. When can I file a revised return? I can file a revised return before 9 months from the end of the financial year. 9 months from the end of the financial year. Provided there is a mistake or omission in that return. That means it should not be a conscious wrong that I have committed. But an updated return can be filed even if it is a conscious wrong. Nothing prohibits you from filing an updated return. Right? So you may file a revised return, you may file an updated return, but only one updated return is permitted. Incidentally, updated returns come at a cost. If you want to update a return within 12 months from the end of the assessment year, you have to pay 25% of the tax and interest that is payable extra. Over and above the tax and interest on the updated income, you have to pay 25% extra on that tax and interest. If you want to revise it beyond 12 months and up to 24 months, you have to pay 50% extra. Please note that the provisions of 234C will require you to pay interest on the extra amount of income that you are showing in the updated return also. The next change that I'll quickly touch on is a change in relation to reassessment, where only one change I'll touch upon. There are other changes also. But one change is that if you see the present provisions of 148, they say that an income is escaping assessment when there is a final audit objection of the CAG, a final objection of the CAG. Now they are seeking to amend it to say that it is not only a final objection of the CAG, but any audit objection, which means there are including two things: any audit objection of CAG, not just final, and any audit objection of the revenue audit party, that is the tax department's audit objections itself. So that is only one change that I will touch on. A couple of quick changes that I will touch on in the context of TDS. Now, you will recall that there is a provision 201(1)(a). In fact, this amendment is very funnily worded. though the objective seems to be different, the way it is worded seems to be very peculiar. See, if you see 201(1)(a), it says that you must pay interest on the delay in remittance of TDS before the 200 statement is filed. Before this statement is filed, you must pay the interest before that. Now, I think some assessees have taken a stand that if I don't pay, department cannot raise a demand. So they are seeking to amend this provision to provide that this misinterpretation should be cleared. Officers can raise a demand. But then the language they have used seems to say that since there is frequent and continuous litigation, the interest shall be paid by the person in accordance with the order made by the assessing officer. That, are they trying to say that whatever the officer raises as demand, you must pay? No, because there is still an appealable order. What they are trying to say is the officer can also raise a demand, but unfortunately, very poorly worded. The next change that I will touch on is in the context of 206AB and 206CCA, where presently the tax rate is doubled in TDS and TCS. The rate is doubled if you are a non-filer. So if I am to deduct tax on you, I must see if you are a non-filer. If you are a non-filer, then your TDS, the TDS or TCS that I have to deduct will double. Who was a non-filer was said that if in any of the two preceding years, if in both the two preceding years, if he has not filed a return, he is a non-filer. Now what they are seeking to do is they are taking only 1 year. So they will take only one preceding year if the due date has expired, the immediate preceding year, or the due date has not expired, the year preceding that. If you are a non-filer, then your TDS rates will double. An amendment in 194 IEA is also proposed, where the TDS is now sought to be made on immovable property transactions, whereby they are trying to provide that the law was made clear earlier that TDS will be on the transaction value, not on the stamp duty value. But now what they are seeking to propose, they are proposing is that if there is a transaction value and a stamp duty value, TDS will be on the higher of the two. It will be on the higher of the two. Right? There was also a lot of discussion made in the context of the provisions of litigation management. I think I will take just a couple of more changes and quickly stop. Now, as far as 158AB is concerned, which is now proposed to be inserted, I don't see much of a change because this is already there in 158BA. Sorry. I don't know what is the change that they are really proposing, excepting providing logically that there will be a collegium. Now, the system is like that, is like this. If there is an issue that is already pending before the jurisdictional high court or the Supreme Court, and if it is an identical question of law as arising in the case of the very same assessee or a different assessee, then the collegium will point that out to the assessing officer, and the assessing officer, after taking the consent of the assessee that it is exactly a similar question of law, will write to the tribunal or the high court that they are not filing an appeal presently, but after the decision of the jurisdictional high court or Supreme Court comes, if they wish to, they will file it. Please note that this does not prohibit the assessee from filing an appeal under any circumstance. 2, even the department can go by this provision only if the assessee accepts. Only if the assessee accepts that an identical question of law is pending before the jurisdictional high court or Supreme Court. So it literally requires the consent of assessee. Otherwise, the revenue will continue to file that. So actually, I don't know how much litigation will get managed as a result of it. We will have to wait and see. Because what will happen is they are only saying we will not file an appeal immediately, but we may file later. Right? So what may happen is that the litigation may get deferred, particularly if it is jurisdictional high court and they want to go to the Supreme Court. In all other cases also they will file an appeal. The last amendment which I will touch on is the amendment that they are proposing in section 263 where they are giving power to the commissioner, the principal commissioner or the commissioner, to revise an order of the transfer pricing officer. I will not take much of your time. I'm already just about touching my time frame. But then one point that comes to my mind is, if in practice, each and every TP order is getting the consent of the commissioner of transfer pricing. Now, how will I as a commissioner give my consent to the order, give my sanction to the order, and also revise it saying it is erroneous and prejudicial? It looks a little peculiar that the procedure which is presently followed may not still permit the commissioner to revise. Likewise, against the commissioner's order, against the assessing officer's order, if there is a TP adjustment, I may go to the DRP. So once the DRP has decided, can the commissioner revise that? DRP is a higher forum comprising 3 commissioners. Can a commissioner sitting singly revise that order? Again, I would think that will be a challenge. So friends, I will stop here for some time and take queries. I already have one query. Can an updated return be filed for cases having nil tax liability? There seems to be no prohibition, sir, on cases having nil tax liability. The prohibition is only where the return is a return of loss. Of course, the other conditions like that you should not have been searched, etc., will continue. But other conditions remaining satisfied, the fact that you have filed nil return originally will not bar you from updating your return. But on the updated income, the incremental liability of tax, etc., has to be paid. So I'll pause here, thanking the organizers once again for the opportunity and all of you for a very patient hearing. Thank you very much.
Thank you, sir. It was a real pleasure listening to you. First, being your student, I would always admire all your classes, and now the same level of admiration, and we really thoroughly enjoyed today's evening. Thank you very much in your busy schedule for accepting our invitation on behalf of Pondicherry and Salem branch. Thank you so much, sir.
Thank you. Thank you.
Thank you, sir. Thank you on our Pondicherry branch behalf, sir. Thank you, sir.
Thank you. Thank you.
Thank you, sir.
Over to Mr. Vignesh to introduce our next speaker.
Thank you, ma'am. Good evening to one and all. A warm welcome to this virtual gathering. On behalf of Salem and Pondicherry branches of SIRC of ICAI, we benevolently invite the resource person, Advocate K. Vaitheeswaran sir, for the technical session 2. Mr. K. Vaitheeswaran obtained a law degree from the Madras Law College and enrolled as an advocate in 1990. He also had obtained CAA from the Institute of Cost and Works Accountants of India and has completed ECS from the Institute of Company Secretaries of India. His legal firm operates with physical offices at Chennai, Bangalore, and provides services virtually across the country. He has over 31 years of experience in advisory capacity as well as through appearance from appellate authorities, tribunals, and courts in matters arising under domestic and international tax laws, excise and customs, service tax, VAT, CST, GST, FEMA, RERA, company law, and ABC. He wrote the first comprehensive book, VAT in India, when VAT was introduced in 2005, and has also authored books on similar credit, books for students appearing in the CA final examinations. He has written numerous articles covering a variety of issues in tax, corporate law, constitutional law, and general laws in both print and digital media. He has recently authored the book, Taxation of Digital Economy, published by Oakbridge, covering international tax and indirect tax aspects of digital world. He is considered as a specialist in tax and legal matters with in-depth knowledge of the business and tax laws. He has addressed numerous seminars and conferences on law and taxation across the country and abroad, and is the most sought after legal professional in GST and business restructuring matters. He is considered as an expert in both direct and indirect tax matters by the industry and professionals. He has recently forayed into technology law and artificial intelligence. He advises clients across the country on various verticals such as manufacturing sector, retail, healthcare, food and hospitality, gems and jewelry, media and entertainment, information technology, education, charitable institutions, societies and clubs, logistics, infrastructure, real estate, shipping and aviation, travel and leisure, banking and financial services. He also advises various associations and chambers of commerce. He is the chairman of the Expert Committee on GST, Madras Chamber of Commerce and Industry, and also a member of the General Committee of Madras Chamber. He is the member of the Finance and Taxation Committee, CII, in the Southern Region, and president of the Revenue Bar Association and president of the Rotary Club of Madras Southwest. He is also a member of SIC, Indo-American Chamber of Commerce. He is the recipient of the Occasional Excellence Award from Rotary. He is actively involved in various social causes through music and also forays into humor writing. In these few words, we humbly invite our resource person, Advocate Vaitheeswaran sir, to take over the technical session 2. Over to you, sir.
Good evening, and it's nice to connect through the virtual platform. I'm able to be in both Salem and Pondicherry at the same point of time, and greet some of my friends whom I know for many number of years. I initially thought of doing a PowerPoint presentation, but given the fact that it's a fag end of the day and members have sat through a nearly 1 or 10 minute session of direct tax, I would not bore you with another PPT. I'll cover key points through an extempore session. Also because of the fact that this is my 4th address for the day, and therefore after a point of time I find myself repeating these slides, and therefore I thought let it be a new flavor for me if I skip the PPT and do on my own original style. Well, to talk on the budget, Part A, Part B are now 2 significant elements of the budget. And in this budget, what is interesting is that Part A and Part B are completely disconnected. Part A talks about so many plans for the future, talks about gaming, talks about entertainment, talks about infrastructure, talks about 25,000 kilometers road, talks about 44 Vande Bharat trains, talks about a 100-year plan, talks about so many things. And Part B, you go back to the old game of retrospective amendments, nullifying case laws, adding a proviso here, adding an explanation there, making officers more powerful than what they are. So there is a complete disconnect between Part A and Part B, but we have to live with it. And being professionals, we discuss Part B in depth. So as far as the custom segment is concerned, as you all know, after GST, excise is dead, except for petroleum products. And therefore, customs is the only mechanism available as a source of revenue for the central government. So typical changes do happen in the customs front. So they have increased duties for a couple of products, like imitation jewelry and things like that. They have increased duty on umbrellas, of course, as if it makes such a huge difference for an economy, which is talking at this level of looking at a $5 trillion economy in a couple of years' time. By an increase in duty of umbrella, you're not going to incentivize local production, and umbrellas will not be the next business technology of the world. But whatever it is, they're all token changes that is announced, saying that because we are increasing custom duty, therefore local production will increase. I don't buy that theory, because of the fact that merely because custom duty is increased, it doesn't mean that automatically local products become cheaper and people buy locally. There are today the imports significantly from China is on everything, right from your plastic dabba to your Holi for the Holi or for the Patasi for Diwali. Everything seems to come from China. Your noodles has taken over from China. So if that be the case, we're having a $70 billion trade deficit as far as China is concerned. So the numbers could be different, but the deficit is significantly high. So if that be the case, we need to look at avenues where how can we incentivize manufacture through tax laws. I would have probably looked at something like this. Business is going out of China. Manufacturing is going out of China. How do we get that business into India? Some businesses coming into India, no doubt, but should you not get much bigger business than what we are getting? Today, if you go to a ready-made garment shop, you'll be surprised. See what happens if we go to a ready-made garment shop, we look at the size. And if the size is okay, we fit and we are happy and we buy and come. And if you know the brand, we just pick up the size and buy. But if you're curious enough, please try to read where it is made. You'll be surprised. In some of the big shops across the country, in our own country, you will find garments made in Vietnam, garments made in Bangladesh, garments made in Indonesia available in our shops. I'm not talking about Burma Bazaar or something. I'm talking about fancy shops which sell garments which are not made in India. And they feel that this is cheaper. So this is a very powerful impact from a textile industry perspective. So what are we doing to ensure that we get back our manufacturing market? We are already losing our export market to these countries. We're losing domestic market to these countries. So which is very, very tricky and dangerous. So how do we get those investments in India? We could have thought about a brilliant tax planning tool. We could have talked about a tax enclave without, 3-page conditions, without conditions to be prescribed, without conditions to be notified, with such other matters as may be prescribed. Without all that, we should have given a clean sheet to get investment in India, to get at least sure that employment can be generated through all these things. But we have missed all that. We have missed the bus, and we simply tinker with these here and there custom duty changes and believe that that would transform our economy into something else. Second aspect of customs that has been changed is that the adjudication process. All of you are familiar that you import goods into the country, you file a bill of entry, goods are assessed. You pay the custom duty and you come out. Now, sometimes the assessment could be wrong, rate could be wrong, value could be wrong, something could be wrong. There could be a need for a reassessment. So the question is, who should do the reassessment? So you have an assessment function, an assessing officer team is available, an adjudication officer team is available. Then there is an authority called as DRI, Department of Revenue Intelligence. Now, DRI does big investigations, massive investigations, where crores of money is involved as in terms of evasion, a lot of transactions are involved. They have a lot of resources to unearth those kind of things. And the DRI does the investigation. Over a period of time, DRI investigation went beyond big matters and went to small matters also. And after finishing the investigation, DRI itself issued show cause notice. So the dispute came before the Supreme Court saying that when assessing officer has the power to assess and he has the power to reassess under Section 28, how can a DRI issue a show cause notice? Supreme Court in the case of Canon India held that DRI has no power to issue show cause notice, and all the proceedings were quashed at various levels. Now what the government has done, the amendment to the Customs Act is to say that the proper officer has always had the power. Whatever power we gave, we always had it. Even if he does not have, he has it now. And what we give now will be valid. And a validation act saying that what all he did before also is valid. So we make a complete U-turn of whatever is promised in Part A. Part A, we talk so much about futuristic, and then Part B, we go backwards and then say whatever mistakes that were done, we'll rectify them and ratify them and validate them. So now DRI has got all those powers as conferred by the Act. But now whether that amendment is valid or not will definitely be tested in courts in terms of time. Now, moving on to GST. The finance minister announced in the Lok Sabha that the January collection was 1,38,000 crores. Now that is the highest GST collection from July 2017 till date. That is fantastic. This amount of money is GST collection is excellent. And if you look at the budget estimates, we are estimating 6,60,000 crores as CGST for 2022-23. It's a huge sum, CGST itself. If you look at the economic survey, it says that 61.3% is the central government share of GST in the budget estimates. That means indirect tax is so high. GST is so high in terms of collection. So GST is doing very well. So if GST is doing very well, what should we do? We should make it simple. We should make it easy. We should ensure that because of that simplicity, more collections come. No, we'll do the opposite. So what have we done? We have amended section 16.2. We have inserted a new clause called as BA, 16.2BA. Now, what is the effect of this clause? Let us say you're a manufacturer. And as a manufacturer, you're based in Pondicherry. You have some 20 vendors in Pondicherry. You have some 35 vendors in Salem. You have some another 200 vendors from Chennai. All of them are supplying you goods. Now, what do? You normally, when you look at a manufacturer supplier, you look at whether the material is suitable, whether he will deliver on time, whether quality will be acceptable to your standards, and your production chain goes smoothly. Now, GST has told you, please check whether it is registered. Therefore, you go to the portal, you check whether his GST number is valid, you are happy that he is valid, and therefore you place purchase orders, he supplies. So 100 vendors supply goods to you. They raise invoices. They charge GST. You receive the goods, you account the goods, you put them into production process, you pay the vendors, you pay the GST to all the 100 vendors, and you want to take credit. Now comes the catch. GST, section 38 has been amended. 41 has been amended. 43A has been deleted. 42 has been deleted. Now what they're saying is that 16.2BA would mean that the government or the portal will give you an auto-populated 2B. this auto-populated 2B would be the basis for your credit. And not only that, auto-populated 2B will give you a list of what is eligible and what is not eligible out of those vendors. See, please understand, you have already known that these 100 vendors are eligible because you are not in 17.5. These are goods which are purchased for business. Out of these 100 vendors, the 2B will tell you, take only this. This you cannot take. Why you cannot take? That fellow, we have some suspicion that he availed fraudulent credit. That fellow's registration is doubtful. That fellow has got a mismatch in his credit. Or such other, he belongs to such other class as may be prescribed. Therefore, even though you would have paid to 100 vendors, your availment of credit is now absolutely going to hinge upon and depend upon the auto-populated 2B. So the moment you are not able to take the full credit despite payment of GST, that amount becomes your cost. If that amount becomes your cost, you are no longer competitive because your selling price is already fixed. You can't change the selling price. So your cost goes up, you end up in losses, and over a period of time, you'll close business. The cascading effect of tax is going to be so severe because of this amendment that is going to affect a number of people. So you may ask me, how will it affect? Now you are a person who is buying from 100 vendors. You feel that because of this 2B business, I don't want to deal with this 30 vendors. So you tell them, I don't want to deal with you anymore. Now, where will they go? They can't go anywhere because that is what they know, that you are the biggest buyer they have. And therefore, you have to enforce compliance. That means they have to file the return. They have to file the return means they have to find cash to pay the GST. You will tell them that I will not pay you GST unless you pay GST to the government. The moment you say that, indirect tax becomes a direct tax for the supplier. Without collecting tax from you, he has to pay upfront. He has to find resources to pay upfront and then ensure that he falls in the good list of 2B. Then only you will get the credit. So it becomes such a complex system that the beauty and life of GST being ITC is being tested drastically through 16.2BA. 16.2 AA, which came in the January 1st, 2022, and this one, which will come at a later point of time, together will make it difficult for a lot of businesses to avail ITC. As if that was not enough, there is another amendment, 4912. That amendment says that you may avail ITC. You may have some 25 lakhs in the electronic credit ledger. We will tell you maximum how much you can use from that ITC. So there will be a notification that says that you can use only X percentage of the credit. Beyond that, you cannot use. The moment you cannot use your full electronic credit, you have to find cash. If you have to find cash, you have to find working capital. If you need working capital, you have to go to the bank and borrow money if you're able to borrow money. If you borrow money, your interest cost goes up. So the more and more electronic cash is required, more and more interest costs will go up, and more will become inefficient from a business perspective and a pricing perspective. So GST amendments of 16.2BA, 49, 12, 38, and some of these amendments are such a significant nature that it can affect a lot of businesses in terms of their ITC, in terms of their ability to enjoy the full ITC, in terms of how they're going to operate. As if that doesn't end there, now they're also saying we will cancel registration under certain circumstances. So if you're a composition registered dealer, if you're a composition dealer, your registration can be cancelled if return is not furnished for a financial year beyond 3 months from the due date. So if you don't file the return beyond 3 months from the due date, you will simply get out of the system. Your registration will be cancelled. Now, who is this composition dealer? He is a small dealer who cannot avail ITC, who pays one small percentage of GST, and his idea is that he cannot maintain records and maintain ITC, but the government wants to help him and collect some tax. Now, by cancelling his registration, even that small amount of tax will go as far as government is concerned. Why do you want to kill somebody from business? I never understand this. Second category, other than composition dealers, registration can be cancelled if returns are not furnished for such continuous tax period as may be prescribed. So the law will tell you, the rules will tell you that if you don't file by X number of tax periods returns, your registration can be cancelled. Why should registration be cancelled? Instead, compel him to file the tax return. Go talk to him and make him pay the taxes. Let his business continue. Because if you cancel the registration, he cannot do business. If you cannot do business, you are creating unemployment by your very nature. Whereas you could have probably reformed that person, got your appropriate taxes, and allowed him to continue. Now, why does somebody not file their return? This is also practical. You're all professionals, you know what is a practical problem. Practical problem is this: monthly tax liability is 5 lakhs. ITC is 3 lakhs. 2 lakhs I need cash to upload the return. Unless I pay through electronic cash ledger 2 lakhs and electronic credit ledger 3 lakhs, the return is not going to get uploaded. If I don't upload 1 month's return, can I upload the next month? No. Earlier month's return has to be uploaded. Therefore, I have to pay the earlier month's tax. Then only I can upload the second month's. If first month itself I don't have money to pay that 2 lakhs, second month also I will default. 2 months I'll default. Somebody will come and say cancel. So we need to realize and understand why he's facing these difficulties. Now, these are not fake invoice fellows. These are not fraudulent fellows. These are not people who are mining the system or evading the system. They are going through some degree of genuine stress. Government should seriously look at what is the issue that people are facing, give them a regularization window, and ensure they come into the chain rather than simply saying we'll cancel registration from so and so date. That is not something which is the best solution in this context. As I said earlier, they are amending, deleting 42, deleting 43, deleting 43A because they are meaningless in the context of the new provisions. They're also amending section 34 credit note. Now the time limit is till November 30th. Similarly, they're amending section 16.4. Time limit is also November 30th for availing the credit. So these are some of the amendments that have been made as far as GST is concerned. The last important amendment, I'll stop with that and take questions from the audience, is that interest. You know that interest in GST, the rate is very high for ITC availment. It's at 24%. So now there is an amendment to say 24% shall be reduced to 18% with retrospective effect from 1st July 2017. So it's a brilliant amendment, welcome amendment. 18% is high, but still better than 24%. Not only that, interest will come only when credit has been availed and utilized. Because what is availment? You pass an accounting entry. You claim the amount in the electronic credit ledger. But merely claiming ITC, does it cause a loss to anybody? No. If I use the ITC and pay output tax and that ITC was wrongly availed, then there is a loss to government. If I use the ITC and claim refund of that ITC, then there is a loss to the government if the ITC is incorrect. Therefore, they are saying wrongly availed and utilized, then you pay interest. If you don't utilize, there is no interest. This is a principle which is laid down by Supreme Court in many matters. That is now being endorsed through a specific provision in the form of section 53. So these are some of the changes that have come as far as GST is concerned and customs is concerned. There are other minor changes which are not very significant for a discussion to this kind of an audience. But if there are any questions, I'll be glad to take it up. I wish to thank the organizers, both the Salem branch as well as the Pondicherry branch, for calling me to share some of the views on the budget as far as indirect tax proposals are concerned. As pointed out by Banusekar, the direct tax proposals are significant and he has comprehensively covered it. Indirect tax, wherever significant, I've covered the discussions. But if you have any questions, you're free to ask. Thank you for a very patient hearing.
Any questions? Members may kindly unmute yourself for any questions. Just see if there are some questions in the chat box. I don't think there are any questions, sir.
Yes.
So can we wind up?
Yes.
So thank you so much on behalf of Salem branch and Pondicherry branches for accepting our invitation and giving us a brief note on the changes. Thanks on your busy schedule. I mean, when you said it was your third presentation today, I know how busy you would have been today. So thank you so much, sir. Even among your busy schedule, you could spend time for the Salem and Pondicherry branches. Thank you on behalf of the managing committee of both the branches, sir. Thank you so much. Thank you, sir. Thank you.
Take care.
Thank you and thank you and Jai Hind. Thank you.
Thank you.
We thank all the members for their participation. We also thank Salem branch for the coordination and the support extended in organizing this program. hope this will be the last program of our Pondicherry branch by the present committee. The new committee will be taking up tentatively on 18th of this month. Details will be shortly shared. And over to Sharda, madam.
Thank you, sir. Thank you. Even this would be the last meeting organized by the present committee. Crowd today. Thank you. Thank you, members. Thank you, sir. Thank you to Pondicherry Group also. Thank you.
Thank you.
Thank you.
Thank you, Speaker, sir.
Thank you.